Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. So the stock market today closed up 0.66% on the S&P, 0.6 and 0.6 on both the Nasdaq and the Dow Jones. Let's take a look at the different sectors. Leading today was healthcare, followed by financials and basic materials and consumer cyclicals. In the middle, really not up, not down, energy, industrials, technology, and real estate flat on the day. The laggards for the day were communication services, consumer defensive, surprisingly, and utilities. So this is a very interesting mix, right? It is not an obvious risk on or risk off mix, because in a risk on move, you would like to see communication services, cyclicals, and technology outperform the rest of the market. But we're noticing something really interesting here. We're seeing healthcare, financials, and basic materials outperforming the rest of the market. And so it looks like big money is betting that healthcare, financials, and basic materials will be the best outperforming sectors for the rest of the year, probably throughout this Fed hiking cycle. Now let's take a look at the stock market map. Some pockets of green in the diagnostics and research sector, in healthcare, as well as banks, more banks, and some more drug manufacturers. Tesla, again, outperforming the rest of the market, doing really well. Tesla fans will be very happy about that. Semiconductors finally showing some green. My favorite stock of all time, AMD, doing the best out of the semiconductor sector today, off a report that AMD is again continuing to take market share from Intel. Notable big losers today were Apple and Google, so big cap tech is now underperforming as expected. As yields shoot up, guys, expect more underperformance by the big cap tech companies. Now let's take a look at the daily chart for the S&P 500. Look at this absolutely beautiful move to the upside. We caught pretty much the entirety of this move. I took profits on the way up, and I'm now net short again. I'm not net long, I'm actually net short, and I'll go through that just in a second. All of you who've been following the videos will remember that by the end of last week, I did say that we will see one more sell-off, flushing stop losses below 390. We got that on Monday. And following Monday, I did say that we will see a bear trap where a lot of small traders will actually pile more into the short side of the trade, when in fact the market was ready for a bounce to the upside to hit $400. We got that exactly. We had the initial rally yesterday, and this rally took us all the way up to our target at $400. That's why I took all of my profits today. I closed all of my long positions. By the way, guys, if you want to support me, you can check out the link in the description to join the trading community. It's 20 bucks a month, and I do post every single trade and investment that I make in real time in the trading community, as well as real-time technical analysis and updates, watch list, trade ideas, all of that good stuff. Now let's take a look at the market action today in the 2-hour chart. Now when the market opened, guys, it looked fairly bearish, right? We had a gap down, and it looked like the stock market wanted to continue to move down. It looked like the S&P 500 wanted to take out this 20-period moving average. We wicked briefly below it, but look at that. We opened right around that 20-period moving average, and we ended up rallying off that level. And as soon as I saw that bounce, I did alert everybody in the trading community. By the way, guys, this is what the trading community looks like. Now it is showing here 5:11 p.m. because I'm at UTC +3, but it was at 10:11 a.m. Eastern time today. And I put this post out. So far, we're holding over the 20-period moving average on the 2-hour chart. The longer we are able to hold, the more buying pressure we will see to push the price up to our resistance level at $400 and the top of the 2-hour Bollinger Band. And if we take a look back at the chart, guys, look at this, beautifully played out as we expected, moving up to $400 and at the top of the 2-hour Bollinger Band. And on the 30-minute chart as well, guys, look at this beautiful bounce, again, off the 20-period moving average on the 30-minute time frame. Beautiful rally. We caught it, and we took profits today. So this is what the trading community looks like, guys. We do have trade alerts, trade ideas, investment ideas, watch lists, some VIP learning resources, very valuable stuff, and some more rooms for members to discuss the stock market, news, as well as to ask questions. We also have a very interesting AI embedded into the trading group. All of that cool stuff. This is what it looks like. If you are interested, check out the link in the description below. It's 20 bucks a month, but if you sign up for the 1-year subscription, there's a 25% offer as of right now. Now let's take a look at the triple Qs. Again, guys, look at this beautiful rally right after we had this descending wedge, this bullish structure. I did say that we will see a bounce back to the upside. We had that bounce, and look at this. We closed right at the edge of this resistance line that I drew up yesterday. And so this is playing out beautifully so far, guys, just as we've been expecting. Now, interestingly, guys, I'm actually not bullish. Even though this might look bullish, I'm actually still bearish, and I want to show you why. Let's go back to the S&P 500. Let me pull up the daily chart and I'll show you exactly what I'm talking about. Look at this. Now, I want you guys to focus on this period of selling, and I want you to focus on this period that we are in right now. Now, I did draw a lot of parallels between these two periods for so many reasons. The first of which is that we had a nice bear market rally, We had a top right here. We sold off aggressively, and we are now selling off aggressively. And both sell-offs came right after the earnings season. So a lot of parallels to draw, and even more similarities. Look at this descending wedge, and look at this beautiful breakout, forming a triple rejection, right? We tested once, twice, 3 times, and we got rejected at 430. 3 times. Now we're seeing somewhat of a similar pattern here. Let me show you what I'm talking about. A descending wedge, a breakout. We had a test of 400, another test, and this is the 3rd test. And that's why I am still bearish. I think this is simply a distribution within a larger, much larger sell-off. And so I did play this bounce back up very tactically. I took profits very quickly. Let me show you some more stuff, some more similarities. Let's take a Fibonacci line from the top all the way to the bottom of this sell-off. Look at this. We went down to the 0.236 Fibonacci level, the 23 Fibonacci retracement level. Let's do the exact same thing here, guys. Let's do that. Let's put this at the 23 Fibonacci retracement level, this sell-off. And look at this. It lines up perfectly with this gap that we have at $380. And so I actually expect some more selling to come and to push us back down to 380 in the short term. That is not a guarantee yet, guys, because I need to see a lot more structure. We could simply just keep chopping around, ping-ponging between 390 and 400 for a couple more days until we see that CPR report next week on the 13th on Tuesday. That'll be a market moving day. So for example, guys, if we open on the 13th at $380, that will allow us to see some reprieve to the upside. But if we open that day, let's say at this resistance level at $400, that may allow bears to pile into that trade and push the market down yet again. Now back to the triple Qs. The triple Qs continue to underperform the rest of the stock market, the S&P 500. If you notice, guys, the S&P has been ping-ponging, hitting that $400 level and selling off. The triple Qs have actually been making lower highs instead, right? We had a lower high, another lower high, and another lower high. So we're still seeing weakness in technology. And that is driven entirely by this beautiful chart. This is the 10-year yield. Look at this powerful move to the upside. We're making higher lows and higher highs. We're still maintaining price action above the 9-period moving average and 9-period EMA. And that is extremely bullish. I'm not seeing any divergences. I'm not seeing anything in the daily momentum. And so I suspect that we'll see a lot more upside in 10-year yields, and that will crush stock market valuations, specifically high valuation companies like Apple, Microsoft, Google, and the rest of the tech sector. Let's take a look at the VIX. Now, guys, this line was actually drawn yesterday. I did not delete it, and I did say that I expect a pullback to this line. And just look at this. I swear to God, I don't have a time machine. I wish I had, but I don't. I guess I just got lucky again. But it made a lot of sense, guys, because if we simply draw a Fibonacci retracement line from the bottom to the top of this move, look at this, the 50% retracement level. We hit that on the dot. Exactly. Absolute perfect hit today. And so we're still firmly in a bullish uptrend in volatility. And a rise in volatility always leads to selling in the stock market. So again, guys, expect more volatility as soon as tomorrow on Friday. Now let's take a look at our friend, the HYG, the high yield bonds, the smart money. I'm not seeing any new divergences and nothing really interesting here. We're making higher lows and higher highs, just like the S&P. I did point out this absolutely beautiful divergence right back here in the previous videos where the HYG put in higher lows while the S&P 500 in the same period was putting in lower lows. This beautiful signal is what allowed us to anticipate and participate in this small bounce to the upside. And very sadly, guys, 99.9% of retail traders don't even know about this signal. That's why I'm so passionate about trading, about sharing my technicals, about doing all of this stuff on YouTube. I simply believe that technical analysis done well always leads to more wins than losses and to wealth generation. That's why I absolutely love technical analysis. That's why I trade mainly based on technicals, but I invest based on fundamentals as well as technicals. I use a mix of both, but that's why I'm so passionate about this, guys. There's a lot of signals that I talk about in this channel that really nobody knows about. I don't see anybody talking about, nobody uses, unfortunately, but you can bet anything that big money is very aware of these technicals and they trade off these technicals. Now let's take a look at the dollar index. The dollar index continues to show some slowing in momentum, right? We had this really aggressive move to the upside. We had this bull flag. We broke out of that bull flag, and it looks like we are just stair-stepping to the upside. In the smaller time frames, guys, we did have this beautiful signal that I talked about yesterday, right? Where we had successive higher highs in the price action while putting in lower highs on the PPO. And again, this signal alongside the HYG divergence signal, as well as this double top that I saw here. I spotted this double top back here. We had a double top with a higher high, and we had a double top over here with a lower high. And so I immediately alerted everybody in the trading community that the dollar is about to break down, allowing stocks to move back up. This made for the ideal time to go long and close your shorts if you had any shorts still open. Longer time frame perspective, guys, yes, momentum is slowing down, but still we're trading perfectly within this ascending channel. We're making higher lows and higher highs. We're still trending up. And as long as yields continue to move up and the dollar index continues to move up, you'll see a lot of pressure on stocks and you'll see a lot of momentum to the downside in the stock market. Now let's take a look at gold. Again, guys, I did talk about this beautiful bullish engulfing candle yesterday, but I did say that it wasn't enough. And by the way, guys, a bullish engulfing candle is a candle that opens below yesterday's low and closes above yesterday's high. So it engulfs the prior candle entirely. And so I am still waiting for gold to make a new low. I expect yields and the dollar to continue to move up. I expect gold to continue to make a new lows. In fact, I'm waiting for gold to make one more push to the downside, form a double bottom formation with a lower low and a higher low on the PPO. So I'm hoping that we'll see something like this. That would be my absolute ideal entry for gold. And we are getting very close to that signal. Now let's take a look at Apple, guys. Apple continues to underperform the rest of the stock market. I mean, the S&P, the Dow, the triple Qs all closed in the green today, but Apple again closed red. Throughout this sell-off, really, guys, Apple has been significantly underperforming the S&P and the triple Qs. And I did warn about this at the top, right as we tagged this resistance line. I did warn about this. Why, guys? Well, because in every single bear market rally that I've seen in my entire life, and since the inception of Apple as a company, Apple has been outperforming the rest of the stock market in bear market rallies. And as soon as those bear market rallies end, you see Apple significantly underperform the stock market. In fact, let me show you what that looks like in this ratio chart. This is Apple divided by the S&P, just to allow you to visualize this significant weakness that has come into Apple. This is Apple's performance relative to the S&P 500, and just look at this absolutely miserable momentum. Momentum to the downside continues to accelerate, and we had this higher high, and we had a lower high right back here, right as Apple formed its top on the daily chart. And so I'm still waiting for Apple to tag this $150 level. This is a key pivot zone because it acted as support in prior sell-offs. And once we busted through that level, it acted as significant resistance. And once we busted through it again, we had a retest and a new rally. So this level really is the 0% retracement level of this entire move to the upside. And Apple absolutely needs to hit this level before seeing any more structure either to the upside or to the downside. I suspect Apple will hit $150 very soon. Let's take a look at Tesla, the beautiful, lovely Tesla. Yesterday, I did outline that my target for the short-term bounce to the upside was at $290, right at the edge of this 20 daily moving average. And we got really within spitting distance of that. We got to 289. And so if I was in this trade, I would be taking profits, but I'm not. I did not play this to the upside simply because the options on Tesla are too expensive. And I do not mean that price-wise. I mean there's a lot of implied volatility baked into these options. So you pay a big premium to trade at Tesla options. With all of that being said, guys, in the medium term, I am still bearish on Tesla. I need to see Tesla test the $250 level again back to these lows. Now let's take a look at oil. Oil continues to show weakness. Again, we're getting very close to this $85 zone where I suspect oil will start to see some buying here. So a lot of chop here. And following that, we will see whether oil will be able to bounce back up or simply continue to sell off all the way down to $65 on crude Brent and about the low 60s on WTI. Again, guys, I did warn about this really aggressive sell-off after I saw this disgusting rejection. Again, I keep bringing this rejection again and again because it is the perfect Wall Street trap, right? We bust through the 50-day moving average. We close above it. Yay. Bullish. We have this beautiful bull flag and we bust through. And then we reverse completely the next day. Not only do we reverse completely, but we take out the prior day low. And we continue to sell off for the rest of the week, and we close at a new weekly low. So I did warn about this. I hated this rejection. I hated this new low on the weekly close. And I did warn that this consolidation is actually probably distribution. It's selling, not buying, because there's a clear difference between this consolidation distribution and this consolidation right here, right? Because this consolidation resolved to the upside and it never made a new weekly low. While this consolidation looked bullish right up until last week's close. I was absolutely in love with Exxon Mobil. I talked a lot about this absolutely humongous bull pennant. And I did say to watch for a break to the upside, taking out this resistance line. And as soon as we saw that right at 96 bucks, we got into this trade in the trading community and we took profits right here. I never ended up getting back into this trade simply because I saw that disgusting rejection on the on oil, and we're now in bearish momentum. We're hanging on so far, but I suspect that this will end up being distribution, and this is supported by the evidence right here. If you notice, guys, we had 3 distribution days with higher volume than the green days, and the green days were even lower than the red days. So we're seeing a lot of selling into strength and some buying, some weak buying into weakness. And so this, I suspect, will continue to sell off. Now let's take a look at the maximum pain for the S&P 500. Maximum pain is sitting now at 396 bucks. And the max pain level, guys, is where the vast majority of options expire worthless. And so if you're a net option seller, if you're a market maker, you want to see max pain getting hit because that's the level at which you make the most amount of money. This level was sitting at $400 just a couple of days ago. Yesterday it was at $397 and it continues to decline. Even though we're seeing strength, I am seeing maximum pain continue to decline, which means that market makers have all the incentive to manipulate the stock market down to at least $396 by tomorrow. This doesn't always happen, guys, but again, this is one more tool to help us assess the odds. Now let's take a look at fear and greed, guys. Market volatility is retesting the 50-day moving average. In prior sell-offs, we saw bounces right off this 50-day moving average. So I do suspect that we'll see volatility come back into the market. Safe haven demand. Bonds are outperforming stocks when this line is going down, and stocks are outperforming bonds when this line is moving up. And as long as this line keeps moving down, it simply indicates that big money is selling stocks and buying bonds. And unfortunately, guys, even after the couple of green days that we've seen so far, still big money is positioned in a bearish bias. And so that indicates that they have absolutely no faith in this bounce that we've seen. And I am in that camp as well. I think we will see more selling. Now let's take a look at the economic calendar. Tomorrow, guys, we'll have a lot of Fed speakers, Evans, George, and Waller. Not a lot going on, but I suspect that we could see some market weirdness around these times when these people speak. Monday, we'll have the consumer inflation expectations. And Tuesday, we'll have the dreaded CPI, Consumer Price Index. And this will be a market moving event. And 1 day later, we'll have the PPI, the Producer Price Index, on September 14th. And this is a very bad date for a lot of reasons. One, we have a couple of very important economic drops coming in September 13th and 14th. And look at seasonality, guys. Mid-September is always when we see the peak in September, and right after that, we see significant selling and weakness. And so we're seeing seasonality line up. We're seeing big money continuing to position themselves with a bearish bias. And we do have a couple of very significant, possibly negative catalysts coming in. Now, in my personal opinion, guys, I do think that CPI will come down versus last month. So I think this number will be good overall. But the question is, how good is it going to be? Is good enough or not? Well, because we do have retail sales coming in on the 15th of September. And if we see strong retail sales, if we see CPI continuing to be very stubborn, especially the core part of the CPI, things like rents, utility bills, and all of that stuff that tends to be way more sticky than, let's say, energy prices, that will be very bearish. But if we see meaningful declines in CPI, this could end up being bullish. So it's really a binary event, either good or bad. And we're still in a bearish downtrend. We do have weak seasonality ahead. And so we have a lot of headwinds. So be very careful out there, guys. And that's really all I have for you today. Thank you so much for watching. And I'll catch you in the next one. Bye-bye.
Oh, wow.